CarMax just sent a massive warning to the entire car market. And if you're thinking about buying, selling, or even holding onto your ride, you need to hear this, because what CarMax just revealed, it could signal the biggest shift in the auto industry we've seen in years. And trust me, it's not looking pretty. In a startling announcement today, CarMax, the largest used car retailer in the US, issued a major warning that's sending ripples through the automotive and retail sectors. The company reported a sharp decline in consumer demand for used vehicles, citing rising interest rates, tighter lending standards, and continued economic uncertainty as key factors. CarMax revealed that its quarterly profits fell by nearly 20%, with same-store sales dropping 9.5% compared to the previous year, a sharper decline than analysts had anticipated. Overall revenue also slipped by 5.5%, while wholesale vehicle sales plummeted even more dramatically, highlighting the broad scope of the slowdown. Immediately following the news, CarMax shares tumbled over 12% in pre-market trading, pulling down other auto-related stocks such as AutoNation and Lithia Motors. The broader market reacted cautiously, with concerns that a cooling used car market could be an early warning sign for consumer spending trends overall. In interviews throughout the morning, industry analysts pointed to a perfect storm of pressures on CarMax and its competitors. Not only are vehicles more expensive due to supply chain disruptions over the past few years, but higher financing costs are also pushing many buyers out of the market entirely. Some experts warn that if the Federal Reserve continues its tight monetary policy, access to affordable auto loans will shrink even further, potentially causing an even deeper contraction. In the used car sector, others suggest that CarMax's warning might trigger broader industry price corrections, as dealers are forced to lower prices to move aging inventory. Looking ahead, CarMax executives said they are focused on tightening operations, reducing costs, and adjusting inventory strategies, but admitted that headwinds could persist through at least the next 2 to 3 quarters. For consumers and investors alike, today's announcement is a stark reminder that after years of booming prices, the used car market may finally be shifting into reverse. CarMax sent shockwaves through the automotive world today, with dire warnings about the state of the used car market, raising fears that the industry could be on the verge of a major downturn. In their latest earnings report, CarMax executives painted a grim picture: steep declines in consumer demand, mounting inventory pressure, and a sharp hit to profits as rising interest rates and tighter lending standards squeeze buyers out of the market. These cracks in the used car sector are beginning to look alarmingly similar to early signs that preceded the 2008 financial crisis, when falling asset values and strained credit markets triggered a full-blown collapse. Like then, today's environment shows key warning signals: inflated prices coming down rapidly, an oversupply of inventory as demand dries up, and increasing loan defaults on auto financing. Adding to the concern, CarMax highlighted that credit accessibility for buyers is tightening at a pace not seen since the Great Recession, leaving many would-be purchasers on the sidelines. Meanwhile, wholesale vehicle prices, a leading indicator for consumer prices, have been dropping month over month, suggesting a broader devaluation across the sector. Analysts point out that during 2007-2008, early cracks in asset-backed markets, like subprime mortgages and auto loans, were dismissed as contained, a dangerous miscalculation that ultimately spiraled into a global financial meltdown. Now, similar complacency could be setting in, as some economists warn that the used car market isn't just cooling, it's on the brink of a serious collapse. Looking ahead, forecasts for the next 6 to 12 months are increasingly grim. Industry experts predict falling vehicle values could pressure dealerships into heavy discounting wars, eroding margins and forcing mass layoffs across the sector. If unemployment ticks up and consumers pull back spending even further, the auto industry, a significant pillar of the U.S. economy, could tip into a recessionary spiral of its own. Some forecasters even suggest that in a worst-case scenario, we could see dealership closures, tightening bank loan portfolios, and a wave of repossessions that send shockwaves through credit markets once again. While it's too early to call it another 2008, the warning signs are flashing red, and anyone ignoring them does so at their own risk. CarMax's stunning warning about plummeting demand and shrinking profits isn't just a red flag for investors, it's a flashing green light for smart buyers. As CarMax reports cracks forming across the used car market, experts are increasingly confident that a major price correction is on the horizon. The combination of rising interest rates, tougher lending conditions, and growing inventories means dealers will soon be under heavy pressure to move cars off their lots fast. And that spells big opportunity for consumers. Already, wholesale vehicle prices are dipping, a leading indicator that retail prices will soon follow. Industry analysts predict that by late 2025, used car prices could fall by 10% to 20%, offering buyers a rare chance to snag deals that haven't been seen in years. If you're planning to buy, patience and preparation are key. Experts recommend that buyers start by closely monitoring local dealership inventories. The bigger the lot, the more motivated the dealer will be to negotiate. Financing will also be critical. Securing pre-approval now can give you stronger bargaining power later, especially if credit conditions tighten even more. However, buyers must be cautious not to rush. One of the biggest mistakes right now would be to buy too early before prices bottom out, or to get locked into high interest loans just as rates might start to cool. Another pitfall: stretching budgets for vehicles still priced at last year's inflated levels. Buyers should be wary of panic pricing. Dealers who offer slight discounts now, but still hold out for higher margins. The real deals will emerge when lots become overstocked and dealers are forced to liquidate inventory aggressively to meet quotas or avoid costly carrying costs. Additionally, smart buyers should keep an eye on off-lease vehicles flooding the market. As lease returns increase through 2025, an oversupply of relatively new, low-mileage cars could create a sweet spot for bargain hunters. Auctions are also expected to heat up with repossessed vehicles, providing even steeper discounts for those willing to do a bit more legwork. Flexibility will be critical. Being open to different makes, models, and even slightly older cars can unlock savings that were unthinkable just a year ago. In short, the used car market is gearing up for a rare buyer's market phase. But timing, research, and negotiation skills will separate those who score big from those who overpay. The window is opening. The smartest buyers will be ready to drive through it at full speed. CarMax's grim warning isn't just about falling used car sales. It's a powerful signal about the broader health of the U.S. economy. Historically, car sales have served as a critical economic indicator because they are tied to both consumer confidence and access to affordable credit. When individuals feel secure in their jobs, optimistic about their financial future, and can easily obtain financing, auto sales thrive. When these conditions reverse, as we are starting to see now, car sales slow sharply, often foreshadowing broader economic trouble. CarMax's report points directly to higher interest rates as a major factor behind falling demand, confirming that the Federal Reserve's aggressive tightening cycle is squeezing consumers hard. Inflation may be cooling at a headline level, but the cost of borrowing remains high, making big-ticket purchases like cars financially out of reach for many Americans. Moreover, CarMax's struggles reveal cracks in consumer spending, which accounts for roughly 70% of U.S. GDP. If consumers are pulling back on auto purchases, typically considered essential for commuting, work, and family life, it suggests they may also cut spending in other critical sectors like retail, travel, and housing. This contraction in discretionary spending could trigger a chain reaction across the economy, amplifying recession risks through 2025. Retailers, banks, automakers, and service industries alike could feel the sting of a tightening consumer wallet. In fact, used car affordability often acts as a canary in the coal mine for the broader economy because it combines several forces at once: wage growth, credit health, inflation trends, and overall consumer sentiment. Right now, every one of those forces appears to be weakening. The big picture implications for 2025 are serious. If interest rates stay higher for longer, as many Fed officials continue to hint, affordability pressures could deepen, creating a sustained slump in durable goods spending. Additionally, tighter bank lending standards, already evident in consumer loan data, could shut out even more potential buyers, compounding the slowdown. CarMax's data also suggests that consumers are becoming far more cautious with their money. prioritizing essentials over larger debt-financed purchases. Should this cautious trend spread, it would undercut the post-pandemic recovery narrative and weigh heavily on GDP growth. Many economists are now revising their 2025 forecasts downward, anticipating sluggish growth at best and a shallow recession at worst. CARMAX's warning is more than just a company-specific problem. It's a reflection of growing systemic stress that could define the next 12 to 18 months of the American economy. Behind CARMAX's public warning lies a deeper story that industry insiders have been worried about for months. And it's about to get much worse for dealerships across America. CARMAX's brutal admission of falling demand, shrinking profits, and bloated inventories is a flashing red alert for anyone in the auto business. For dealers, it's not just about lower sales volumes. It's about rapidly eroding margins, skyrocketing carrying costs for unsold inventory, and dangerous shifts in consumer financing behavior. Insiders track hidden metrics like days to turn, how long a vehicle sits unsold, and floor plan interest costs, the fees dealerships pay to finance their inventory. Both metrics are already spiking, meaning that every day a car sits on the lot, it bleeds more money. In response, many dealerships are already slashing prices behind the scenes, offering larger than usual incentives, secret markdowns to repeat customers, and even aggressively wholesaling vehicles they can't move. Some dealers are also quietly pulling back on inventory orders, trimming staff, and tightening advertising budgets. Clear signs that they're bracing for a deeper collapse. Meanwhile, floor plan lenders, the banks that finance dealership inventories, are getting nervous, pressuring dealers to move stock faster or risk credit line reductions. The secret signs the crash is already underway. Sharp increases in dealer-to-dealer auctions, heavier than normal discounting at the back end of the month, rising repossessions of financed vehicles, and a noticeable shift in dealer attitudes. From aggressive expansion to survival mode. Even major dealership groups that were once aggressively buying up smaller players are now pausing acquisitions, conserving cash, and restructuring operations for a tougher year ahead. On the ground, experienced sales managers are reporting a worrying trend. Customers are becoming far more hesitant, sitting on approvals without closing deals, asking for bigger discounts, and walking away when terms aren't ultra-competitive. This behavior didn't exist a year ago, when supply was tight and buyers were desperate. Now, the power is slowly shifting back toward the buyer. And dealers are feeling the squeeze harder than they publicly admit. If wholesale prices continue their sharp drop, many dealers could soon find themselves upside down on their inventory, meaning they owe more on their floor plan loans than the vehicles are now worth. This exact scenario crushed many dealerships during the 2008-2009 crash. And the playbook is eerily similar today. CarMax's statement isn't just an earnings update. It's the first domino falling in what could be a brutal reset of the entire used car industry. CarMax's latest earnings report sent shockwaves through the market, as the company revealed a sharp 20% decline in quarterly profits, a 9.5% drop in same-store sales, and shrinking margins due to weakening consumer demand and tightening credit conditions. The immediate reaction was brutal. CarMax's stock plunged more than 12% in a single day, wiping out billions in market value and sparking a broader sell-off across the auto sector. Beyond just CarMax, the warning signs are rippling into related stocks. Auto dealerships like AutoNation and Lithia Motors, lenders like Ally Financial and Capital One, both heavily exposed to auto loans, and parts suppliers such as LKQ Corporation are all under fresh pressure. When used car sales slow, the ripple effects are massive. Fewer loans originated, fewer parts sold for repairs, and falling asset values that stress both lenders and dealership balance sheets. For investors, the picture is complex. Risks are clearly rising. Consumer credit is tightening, repossessions are ticking higher, and wholesale price declines are likely to erode asset-backed securities tied to auto loans. Dealerships face margin compression and potential inventory write-downs if retail prices fall faster than expected. Lenders could see higher default rates just as the Federal Reserve keeps interest rates elevated, squeezing profitability further. However, sharp corrections often create opportunity. Some analysts suggest that the coming months could offer entry points for long-term investors willing to stomach volatility, especially in companies with strong balance sheets, diversified revenue streams like financing and repairs, and heavy exposure to the parts and service segments, which tend to be more recession-resistant. Still, caution is key. The auto industry cycle is clearly turning, and anyone investing now must be selective, focus on fundamentals, and be prepared for a rocky 2025. CarMax's meltdown is a wake-up call that the easy money era in auto stocks is officially over. More concerning for investors is how deeply intertwined the used car market is with broader economic health. Consumer credit quality and household balance sheets are under strain from rising rates, and auto loans are typically the second largest form of household debt after mortgages. A sustained collapse in used car prices would hit not just auto dealers and lenders, but also large banks, insurance companies who use car values for claim settlements, and even sectors like consumer discretionary retail, where big-ticket spending is critical. The risk of contagion, small today, could grow if defaults and delinquencies rise faster than expected. At the same time, some segments of the auto space could prove to be resilient winners. Companies focused on repairs and maintenance, like O'Reilly Automotive and AutoZone, often see steady or even rising revenues in downturns as people hold onto their cars longer and invest in maintenance rather than replacement. Similarly, specialty insurers and niche lenders with tighter underwriting standards could outperform their peers. Investors willing to dig deeper into balance sheets, credit exposure, and pricing power will be best positioned to find opportunities in what's shaping up to be one of the most volatile periods for the auto sector in over a decade. Beneath the surface of CarMax's ugly earnings report is a much bigger story that few in the mainstream media seem eager to touch. The used car market is collapsing faster and harder than the headlines are letting on. While outlets have mentioned softening demand and inventory challenges, they're largely downplaying the real severity of the situation. Why? Because a full-blown car market crash would send shockwaves through consumer confidence, banking stability, and the broader economy, right when policymakers are desperately trying to project an image of a soft landing. Insiders at dealer groups, auction houses, and lending firms are already seeing the truth unfold. Repossessions are surging at a rate reminiscent of the 2008 financial crisis. Auction prices are in freefall, and dealers are panic-dumping inventory just to survive. Vehicles that once sold in bidding wars now sit for weeks with little to no interest, forcing dramatic price cuts that haven't yet fully trickled down into public pricing indexes. CarMax's financials effectively blew the lid off the industry's whispered fears. But few major outlets want to connect the dots. The crash is not starting, it's already well underway. Floor plan lenders, the banks that finance dealer inventories, are tightening the screws, cutting dealer credit lines faster than reported. Small and mid-sized dealerships are quietly facing existential threats, and wholesale auction prices, a leading indicator, are dropping at a pace that insiders call terrifying. Public data often lags reality by months, meaning the true scale of the collapse won't be fully visible to the average consumer until late 2025. By then, the damage could be irreversible. CarMax's earnings miss is only the first crack to break, the surface. Underneath lies a deep, fast-moving fault line that could reshape the auto market and possibly even ripple into the broader economy in ways few are prepared for. Even more suspicious, look at who stands to lose the most if the truth gets out early. Major banks heavily exposed to auto loans, big publicly traded dealership groups relying on rosy investor sentiment, and federal regulators already under fire for how they've handled inflation. No one wants to admit that a critical consumer sector is collapsing while they insist the economy is strong. Behind closed doors, some dealership executives are even starting to whisper about mergers, fire sales, and exit strategies. Conversations that don't happen unless things are truly dire. Add in the spike in early-stage loan delinquencies, the silent wave of voluntary vehicle surrenders, and increasingly desperate discounting at auctions, and the picture becomes crystal clear. The car market crash is real, it's accelerating, and it's a lot worse than Wall Street and Washington. want you to know